I'm joined now by a familiar face, my colleague Karen Manczko. Karen, it's great to have you back for the update. Tell us how the Wespath funds performed in the third quarter.
Thanks, Joe, and hello, everyone. It's great to be back and provide this update. Since the last quarterly update, the markets have been somewhat of a roller coaster. Stocks ended strong in the month of July, and this continued into the first half of August due to the belief that the Fed would pivot from its aggressive stance in raising interest rates. Unfortunately, those gains were short-lived when the Federal Chairman Jerome Powell had a hawkish tone at the August meeting in Jackson Hole, hiking rates by 75 basis points. This adversely affected the markets, and they continued their downward decline the rest of August and in September. You can see on the slide that both equities and fixed income assets ended the third quarter down. I'll spend more time talking about the individual fund performance, contributors and detractors for the quarter on the following slides. But you can see on the chart that the U.S. equity, fixed income, and the Inflation Protection Fund outperformed their respective benchmarks, which led to the Multiple Asset Fund outperforming for the quarter.
So before we move on, Karen, can you talk about the year-to-date performance?
Of course, as you can see on the slide, it's been a challenging year so far for equities and bonds. As a reminder, what's been driving the market performance has been a difficult culmination of many domestic and international factors. Global central banks aggressively tightening, inflation rising to its highest levels in 40 years, the Fed rate hikes continuing to create losses for bonds and concurrently dampening the equity markets, the ongoing conflict between Russia and Ukraine, and the fear that a recession is on the horizon. You can see that the equity funds are down over 24 and 30% year to date. And what is impacting the international markets is the strength of the US dollar, which is up over 16% year to date. International markets are also experiencing weakness in growth, high inflation, much like the US. Both the US and equity funds have been negatively impacted by our external investment manager stock selection. The stocks that these managers held for many years have been out of favor in this market environment. Joe, I believe you shared with me recently that you read that 80% of active managers have been out of favor this year.
That's right, Karen. S&P publishes data showing active versus passive managers. So for U.S. managers, about 80% underperformed in the first half of the year, but have been slightly better in the second half of the year, similar to what we've seen in the managers in our funds.
Yeah, the International Equity Fund is roughly 85% actively managed, and the U.S. Equity Fund is approximately 50% actively managed. Active management has benefited our fixed income strategies in particular. The fixed income fund is 100% actively managed. You can see on the chart that the fixed income fund has outperformed its benchmark year to date, despite being down on an absolute basis. And the reason for the outperformance has been the fund's allocation to our internally managed positive social purpose lending program and agency commercial-backed securities, also the allocation and manager issue selection in high yield, and the fund's underweight to investment-grade credit. You can see on the chart that the Inflation Protection Fund is down 7.9% year to date, but it's outperforming its benchmark by over 5 percentage points. The fund's diversifying strategies of floating rate senior secured loans, commodities, plus the fund's underweight to UK inflation-linked bonds has benefited this fund on a relative basis. Despite the two bond funds outperforming their benchmarks year to date, the underperformance by the two equity funds have been the reason for the underperformance of the Multiple Asset Fund year to date ending September 30th.
So I noticed you included the short-term investment fund on this slide. Any comments you want to make on that before we move on?
You're right, Joe. The one fund that I'll highlight that we typically do not is our short-term investment fund. This fund's goal is to preserve capital while earning current income, generally greater than that of a typical money market fund. The funds primarily holds short-term fixed income instruments, including U.S. government, agency, and corporate bonds, securitized products, commercial paper, certificates of deposit, and other similar like investments. My colleague Evan recently wrote a blog that talks about this fund and how it's positioned to better capitalize on the interest rate environment when compared to typical CDs and money market funds. You can see for the quarter, this fund was up roughly 0.5%. One thing I do want to mention about this fund is that it's best for near-term investment needs, such as near-term obligations, projects, or operating expenses. An endowment, when the time horizon is perpetuity, the best option is to continue to have a diversified portfolio of stocks and bonds that will provide that more competitive rate of return in the long run.
So you showed us how the multiple asset fund fared relative to its benchmark. how does the fund look relative to other balanced funds?
Looking at this chart, it showcases the multiple asset fund versus a universe of balanced funds. And the point of the slide is to measure how our balanced fund, the multiple asset fund, performed relative to other balanced portfolios and funds that are currently on the market. So we're using a universe that is compiled and maintained by Investment Metrics, which is a well-known reporting provider in the investment industry. So looking at the chart, you can see that the multiple asset fund has performed below the median for the 1-year time horizon, but outperformed the median in the 3, 5, and 10-year time horizon. For instance, in the 10-year, the multiple asset fund outperformed over 58% of other balanced funds in this comparison.
So Karen, moving on, tell us about the individual fund contributors and detractors for third quarter performance.
Yeah, starting with our multiple asset fund, I highlighted this on the performance slide earlier, but the primary detractor to the fund's third quarter performance was the underperformance by our international equity fund, which I'll specifically highlight here in a moment.
You mentioned earlier that the markets started the quarter with the equity markets positive in July and the first part of August before taking a turn after the Fed's latest rate hike. How did this impact the performance of our funds?
That's correct. We've seen some major market movement so far this year, which had a negative impact on both equity and fixed income markets. Starting with our U.S. equity fund, this fund outperformed its benchmark by 92 basis points for the quarter. The fund's dedicated allocation to private equity and private real estate contributed. As a reminder, these asset classes are priced on a 3-month delay. The fund's overweight to small and mid-cap growth stocks also contributed.
So Karen, you mentioned during your comments that the International Equity Fund was the only fund to underperform for the quarter. Can you explain why?
I highlighted this earlier when I spoke about the year-to-date performance of the International Fund being the active manager stock selection and their portfolios being out of favor in this market environment. You can see listed on the slide the growth-oriented active manager stock selection in China and e-commerce has had a negative impact on the fund's performance. Some of the stocks that detracted were Shopify, which you recall did really well in 2020 and before. Also, stocks like Snap and Okta detracted. Also, the fund's allocation to international private equity has been a detractor to the fund performance.
All right, moving on to the fixed income fund's performance. The equity market has not been the only market that has seen some volatility, but we've also seen it in the bond market. This has been one of the worst bond markets in history, with bonds displaying double-digit equity-like losses.
Yeah, the bond market traditionally has been seen as a safe haven for investors when the stock market's volatile, but this asset class has not been able to hide from the volatility that we've been experiencing. The main driver of the bond market performance has been the ongoing inflation concerns and the Fed's goal of trying to control inflation by increasing interest rates. But despite that negative absolute returns by our fixed income fund, it outperformed its benchmark by 64 basis points gross of fee. There are a number of contributors that we've listed on the left-hand side of the slide, but the primary reason for the outperformance was the fund's overweight to high-yield bonds positively contributed to the performance, along with the issue selection of a number of investment managers in the fund, such as emerging market debt, investment-grade credit, and the fund's core plus managers. Detractors to the fund performance include the fund's allocation to global bonds, which was negatively impacted by the increase in the U.S. dollar.
And moving on to our final fund, the Inflation Protection Fund. It looks like this fund significantly outperformed its benchmark for the quarter.
Yeah, the Inflation Protection Fund has really showcased its purpose, not only last year, but also this year, since inflation is an ongoing concern and really could be for some time. As a reminder, this fund was created to protect investment portfolios against unanticipated inflation while providing a stream of income. It ended the quarter outperforming its benchmark by roughly 1.64 percentage points. That primary reason for that outperformance is the allocation to floating rate senior secured loans and the allocation and manager selection in emerging market inflation-linked bonds. Also, relative to the fund's custom benchmark, the fund is underweight UK inflation-linked bonds, which contributed to the fund's performance. As I conclude my portion of the webinar, I wanted to inform our viewers that we continue to actively engage with our external investment managers regarding the markets and their portfolios daily. We continue to have conviction in the fund's diversifying allocations and have not made any major adjustments or shifts to the fund's underlying allocations. We have confidence in the managers that we have selected and hired to manage the assets on behalf of all of our investors. Our best interest is our clients' best interest, and we are here to work with our clients to ensure that we are continuing to invest on their behalf that allow them to meet their financial goals and support the mission of their organization.
Thanks for the performance update, Karen.